Good afternoon, everybody, and welcome to this week's weekly macroeconomics session this Friday, the 29th of May 2015. Sitting alongside me this afternoon is Jeff Saffer, as always, the head of the Elite Investors Club. How are you going, Jeff?
Yeah, good, thanks, Dave, and good afternoon, everyone.
We've had a raft of data this last week that's perhaps been a little bit market moving in some of the releases to do with Australia in particular, so we'll go through and discuss that. And we've got some new data coming out this week overseas, in China, the US, and also in Australia as well. So let's get underway. First of all, our disclaimer: and the content of this presentation or any other Elite Wealth Club material does not constitute a recommendation, nor does it take into account your investment objective, financial situation, or particular needs. So please consult your licensed authority before taking any action based on the material contained in the following presentations. Got that out of the way now, Jeff, so let's have a bit of a look what happened this last week. We had some news coming out of Australia, in particular the MI leading index month on month came in at 0.1%, and then that was followed up with private capital expenditure, where the figure came out minus 4.4% versus a market expectation of 2.3%, Jeff. Can you just explain for our listeners what that actually means, particularly the private capital expenditure?
Yeah, so what this is looking at is basically business investment or business spending. So this is for the first quarter of 2015, and businesses spent, almost over 4% less than the same time last year. So obviously businesses are cutting back on their spending. It's been a pretty big story over the last few years how the mining sector, mining companies have stopped investing in big projects. So that's not a surprise.
Yep.
That's a very well-known trend, but it's been hoped, and the RBA and the government as well has been expecting and hoping that as the mining investment dies down,
Yep,
other sectors will pick up the slack.
right.
And what this result showed is that that's not really happening. The mining sector is definitely slowing down, but the other sectors weren't sort of pulling their weight. And the really interesting numbers or data to take out of this is not so much what happened in the last quarter, but businesses were surveyed about how much they were planning to spend in the next financial year, and that was much lower than expected. So businesses are feeling pretty nervous.
Yep.
Businesses stop spending, then it's going to hurt the economy.
Yep.
There was basically disastrous numbers. The only saving grace is that it's before the budget came out, and maybe the tax incentives in the budget might kickstart business a little bit.
Right.
Particularly small and medium businesses.
Yep.
But generally, it's a pretty bad result, enough to really push the Aussie dollar down about a cent in the last 24 hours.
Yep.
So some pretty bad data there. And you mentioned the MI leading index as well. I spoke about this last week. It's an index that actually covers other economic releases. On one hand, it's not that helpful because most of the data is already out. So it doesn't really move the market. But I like looking at it because it just gives a nice little snapshot of what's going on. And you can see a result of 0.1%. So it's positive, but it's very, very low.
Yep.
And that really just summarises exactly what's going on in Australia right now, that in theory the economy is growing, but very weakly, very slowly.
Yep.
And the outlook is not completely negative, but there's not a lot of positivity there.
Yep. So in terms of the private capital expenditure, how long do you think it'll be before we start to see that tick up, or what's going to create a turnaround in that capital expenditure?
Look, as I mentioned, obviously, if small businesses start spending a bit more on the back of those the tax breaks.
Yep.
Otherwise, it's pretty difficult because it's a lot of the money is made up of large projects.
Right.
So multi-billion-dollar LNG projects are some examples of what has boosted the numbers in recent years, and we're not going to get that kind of spending.
Sure.
Things also infrastructure projects, so things like tollways in Victoria and Queensland that are not going ahead and things like that. They're multi-billion-dollar spending that is not happening.
Yep.
And there's a bit of toing and froing between the federal and state governments about funding and spending. So, look, in the near term, there's not really a lot of prospect for that turning around in a big way.
Okay. Now, over in the US, we had important data out this last week. Core durable goods orders there, 0.5 versus 0.5, coming in at expectations there. Consumer confidence still on the rise there in a broad sense. We had new home sales kicking in a little bit higher than the previous figure there. We've got GDP coming out tomorrow, actually, so we haven't got that data just yet. We've got a chart up there of core durable goods there, Jeff. What can you make of the recent, I guess, the recent figures that are showing that core durable goods orders, if you like, are on the negative side of the ledger, so to speak?
Yeah, so this is, I guess, a similar kind of measure to this private capital expenditure. You're looking at companies and government investment in durable goods, so in major assets, not just spending on wages and things like that, but investing in new factories and new major products. So as you mentioned, the reading came in as expected at 0.5, but the reason I've put the chart up there is you can actually see that as you mentioned, most of the numbers have been negative. And if you can see the little orange dots on the chart as well, that's what the market was expecting.
Yep.
And the blue bars is what was delivered. So for the last, I think it's 6 or 7 months, this durable goods orders has been worse than expected. This month was bang on target.
Yep.
They actually revised last month's as well. So they went back, checked their numbers and went, hang on, last month was even better than we thought. So a couple of months of this in a row, if businesses are investing,
Yep.
That means that, and you don't do that on a whim.
Yep.
You do that if you're fairly confident about the long-term outlook.
Yep, because that's a forward-looking type of
Exactly. Yeah, I
indicator.
mean, you might spend a little bit of money if you're not too sure about where the economy's going, but you won't invest millions of dollars in a big project without looking 1, 2, 3, 5, 10 years out. So if businesses are feeling much more confident in putting their money on the line, that'll be one of the things that the Fed is looking at.
Yep, makes sense.
And they can say, oh, yep, look, businesses are investing again. We can probably raise rates, and they're looking 5 years out now, and they're fairly comfortable. So that was a big thing. It actually pushed the US market lower, and the US dollar stronger, on the fact that it's one more piece of the puzzle saying that US is recovering. Consumer confidence, as you mentioned, a bit above expectations and still very, very strong. And new home sales, I spoke about last week. If the property market's strong, then consumers are spending.
Yep. Okay, and then Japan. This last week we had retail sales year on year coming in at 5.5% versus 5.05 versus 5.3. Would you consider that to be much of a difference there, Jeff?
No, look, that's pretty close. I mentioned last week that there was a bunch of Japanese data out. That's been out this week.
Yep.
On its own, it probably didn't have a huge implications for the market, but putting it all together, and there was a Japanese monetary policy statement come out in the last week as well, and putting it all together, and we're starting to see some signs of sort of improvement in Japan. On one hand, the statement said that they're sticking to their easing bias and pumping money into the markets. With asset purchases. So that sort of quantitative easing is not going to change. Still, strategy is the same, but we're seeing some decent rise in retail sales, decent improvement in business sentiment as well. Seeing a bit of inflation as well. And I mentioned last week that the Japanese are in an unusual situation where they want to actually push inflation higher.
Yep, because they've been in a deflationary environment for years.
20 years, decades really now.
Yeah.
But sort of worsening recently, so they're trying to kickstart things over there, and we're actually seeing some early signs, and a lot of things are moving in the same direction. So I think their policies of the last 12 months are working.
Yep.
Which is an interesting sign.
Yeah. Okay. Well, let's go and have a look at some of the markets now. I'll just bring up Beyond Charts here and just have a bit of a look at our typical markets that we look at, the XJO and also the S&P 1500 as our benchmark indices for both Australia and US respectively. So here we've got the ASX 200, and you can see that over the last few weeks, after mentioning falling out of a fairly much a sideways type of range, we actually came down and hit a support level, which was coinciding with some older points of supply, if you like, some older resistance levels now acting as support levels. I made a comment that it would be really good if our market could certainly close above the 57.50 level. And it looks like it's going to do that this week, today being fairly strong on the market. So with a little bit of luck, if we can consolidate around about this area, then I think we've got a reasonable chance of getting back up towards the 6,000 level. Our stochastic was below 80, still above 60, so we're still in moderate risk market for the time being. If the price action continues to the upside, then that will drag the stochastic back up towards the 80 level and hopefully put us back in a lower risk environment. So that's on the XJO at the moment. We'll go.
So I guess.
Sorry, Jeff.
Yeah, I actually mentioned to my Elite Investors Club members yesterday, I delved into the technical side of things, try not to step on your toes. But I actually also pointed out the fact that the sort of recent lows have been fairly similar to those highs set last year. And as you pointed out, it's obviously, look, if we close above 57.50, I guess the conclusion is maybe this was the pullback we had to have, in a sense, after that big run-up. We spoke about that couple of weeks ago. And so maybe that pullback is had its run and ready to resume after that.
Right, so let's go and have a look at what's happening in the US by comparison. Again, we mentioned that the US has been fairly choppy of late and continues to drift upwards, albeit very slowly. A lot of movement up, but also down as well. And just last week we were saying that it looked like it was just starting to break out of sort of a bit of a resistance level there, very tenuously. You can see the candles are very small, wicks on either side, a fair bit of indecision. Then we had a fairly big down day during the middle of the week, followed by a strong up day the following day. So really at this point we're starting to see rising troughs coming through, which is a good sign for this market. It would be nice if we could close above these previous levels. That would certainly be a vote of confidence, but we'll just have to wait and see whether that eventuates or not. At this point in time, we're still in low risk, the stochastic still being above 80 there. We just wanted to, for curiosity's sake, have a look at a couple of other markets. This one here is the Nikkei. So we've been talking about the Japanese market and their versions of quantitative easing, so to speak, Jeff, to try and boost inflation, etc. And you're talking about asset purchases, etc. And this is really being reflected in their market. Again, if we were using the same benchmark, the same risk profiles as we do on our local markets in the US, we'd be looking at the Japanese market and saying, well, look, we're in a low risk environment over there at this point in time. And you can see quite evidently in their index, there's a lot of white candles right throughout over the last, probably 6 to 12 months. It's been a very much an outperforming index, and one certainly that if you've got an awareness of what's going on in other markets, you can take advantage of through, and we spoke about this last week, through ETFs to get exposed to those other markets. So it'll be interesting to see what impact their monetary policy has over the next few months, and whether they seem to get inflation occurring or not. And if they do, what sort of impact do you think that might have on the market, Jeff? Is that sort of something that's going to stop the Nikkei in its foot tracks, or do you envisage something, perhaps a transition, a pausing type of effect?
Yeah, look, there's probably two main drivers of the Nikkei right now and into the next 12 months. And that's, as you mentioned, the first one is the monetary policy. And obviously the US is pulling the handbrake on that, and they started early. And now you've got sort of Europe and Japan trying the same thing. So I think Japan will have that as a tailwind for some time. And the other thing at play, really driving the Japanese market higher, is the weak yen. So the US dollar's going up, the yen's weakening, and that means that Japanese companies will sell more product. The exporters, so your electronics companies and car manufacturers. So, and that's really what's pushing the Nikkei higher right now.
Yeah, okay. I just wanted to bring in there, just for curiosity's sake, just a chart of the dollar yen. You'll see, particularly recently there, Jeff, there's a big spike in the dollar yen as well. So obviously the weakening of the yen versus the US dollar in that case. All right, so let's just go back to our indices there. So we've got that's the Japanese market. The other one of note this week was the Shanghai Stock Exchange Composite. So this represents the Chinese market, and that last candle there, great big black candle. This is a market that again has performed really well this year. Currently, you can see a lot of strength. The angle of the rise, if you like, is quite extreme. Just recently there, Jeff, that last candle represented about a 6% drop overnight. What's the background to that?
Yeah, so Chinese broking firms tightened their margin lending requirements.
Yep.
So obviously requiring investors to put up more capital. And if you put that in context, the market's basically more than doubled in a little bit over 6 months. So it's gone through an absolutely huge rally. And like you said, the rally just got so steep near the end.
Yeah.
Obviously, everyone has just been pumping money into the market, and a lot of that was done on margin. I think they've got record levels of margin lending over there.
Yeah.
To make sure that it doesn't get all too hot, they periodically tighten the margins, telling investors you've got to put up more capital. And in a lot of cases, investors are so highly leveraged, they go, well, I don't have any more capital. I'll just have to, the only way to bring down my margins is to sell my shares.
The cupboard's bare.
The cupboard's bare, exactly. And so everyone just basically sells out. And especially after you've had such a spectacular run, it just takes something like that and everyone's just taking profits. Even the people that do have capital, they're taking profits.
Yep.
The ones that don't are just getting out.
Yep. All right. Well, let's jump back into our slides there. So that's the week that was, and a bit of a look at the markets there. This coming week in Australia, we've got the RBA cash rate. So the first Tuesday of every month, Glenn Stevens will get together with his colleagues and decide what they're going to do with our cash rate. We've also got GDP quarter on quarter coming out on Wednesday as well. So it'll be interesting to see what sort of data comes out there and whether that moves the market to any large degree. Jeff, what are you expecting with cash rates?
Yeah, look, rates will be on hold at 2%. That's an almost certainty this month,
Yep.
Or should I say next month. And I suspect that the RBA will say that rates are right where they are,
Yep.
and they probably won't have any language to say that they'll cut further if needed. So I don't think you'll see there won't be much to see there on Tuesday.
Yep.
In terms of GDP, the last few quarters have been pretty weak, at around 0.5% or a little bit lower a couple of quarters ago, and there's not a lot to suggest that that's going to jump up significantly for the March quarter either.
Okay. All right. And in the US, we've got an interesting week. We've got non-farm employment change on Wednesday, and then we've got, importantly, the trade balance. I'll get you to talk about that in a moment. The first Friday of every month in the US, we have non-farm payroll. So we're interested to see what sort of what changes we're getting there in terms of employment, and obviously that unemployment rate as a result of that being calculated and coming out on Friday as well. Jeff, the chart that we've got up there at the moment, the graph, we've got USA trade balance. What can you tell our listeners about the chart there, and what do you make of it?
Well, I mean, at first look, it looks like the chart's upside down.
It does.
You've got all the bars coming from the top to the bottom.
Yep.
So what that indicates is that all these numbers are negative. And you can obviously see that literally every single month you've got negative readings of tens of billions of dollars.
Yep.
And that's because the US is importing more than it's exporting. And what's interesting is you can notice in 2009, obviously the chart heads back towards the top.
Yep.
And we had the consumer confidence chart up in recent weeks.
Yes.
And it's almost the inverse
It's
of
almost
that.
opposite, isn't it? Yeah.
If you've got time, go look at the trade balance chart and the consumer confidence. You'll see when consumers are confident, they're spending money, and the Americans are importing more.
Yep.
And then they lose confidence, and like in 2009, stop importing, and the chart goes up. So if you look more towards the recent times, obviously it's been hovering somewhere around a $40 billion trade deficit.
Yep.
And then last month we saw a spectacular miss where it extended out to 51 billion. That big blue bar at the end, and that's, in my opinion, that's really based off the strong US dollar.
Yep.
Strong US dollar, so businesses and consumers are importing more, and they're exporting less. I think you'll see probably another wide deficit there as well.
Yep.
In terms of the rest of the news, really, the other three bits in the US are obviously all around jobs. and we've seen some mixed numbers in recent months, but generally speaking, these are on the improve.
Yep.
So that's I'll probably expect more of the same there.
Sure. In China, we've got manufacturing PMI there on Monday, and we've got the HSBC PMI on Monday as well. Jeff, we've got two PMIs there. What's the difference? Are they the same? What does it mean?
So the manufacturing PMI are the official Chinese government figures,
right?
And then the HSBC is obviously provided by that institution. Comparing the two institutions, we put a lot more faith in HSBC than we do in the Chinese government. So we follow the HSBC figures more than the official ones.
Yep.
The official ones have a habit of coming in exactly as expected and not sort of fluctuating all that much.
Right.
So the HSBC is what we'd be looking at, but the final numbers, I talk a lot about the flash numbers.
Yes,
that comes out about 3 weeks into the month, and that's sort of like a preliminary reading. That's the one that moves the market. The final doesn't change as much because it's a week and a half on, and they go, look, it's a little bit better or worse than what we told you recently.
Yep.
So I don't think those two will move the market all that much.
Yep. Okay. Certainly over there in the Eurozone, we've got the ECB press conference on Wednesday. So I take it Mr. Draghi gets up and speaks to the press on that day?
Yep.
Yeah. What are you expecting him to say?
Oh, look, probably the big story is not necessarily just the press conference, but the Greece has a debt repayment due next week. They owe a couple of billion, about 1.8 billion American dollars to the IMF, and in the Greeks have actually come out and say we have no money.
Oh,
we can't pay you. And look, this has happened. There's been numerous debt deadlines for the Greeks over the last few years, and typically, fairly close to the deadline, they've come up with an agreement. They've rolled over the debt. They've come up with some sneaky manoeuvring where the Greeks have been able to access more money from a different area, and then it's almost like the IMF is actually paying itself back by releasing special emergency funds to Greece that Greece then pays the IMF.
Recycles and gives back to them.
Exactly.
Right.
But this time I don't think there'll be any recycling. The politics are a little bit different as well. The fairly new Greek government is not all that keen on austerity measures. And doesn't have that much in the past. The Greeks have basically said, look, lend us some more money and we promise we'll fix things further. There's probably not that much more they can add now. So, look, there is a real possibility that the Greeks might default next week.
Yep.
Which will have major implications, obviously, for the euro, for Greece. There is the chance that Greece might actually pull out of the euro.
Sure.
Which probably would be good for Greece.
Yep.
Probably would be somewhat bad for the rest of the euro.
Yeah. Okay. Interestingly, we've got GBP. That's obviously relates to England. There, the official bank rate over in the UK. There was recent talk on the radio this morning that there might be consideration that England might leave the eurozone. Is that?
Yeah. Look, I don't see that as a reality.
I think it was the Queen who was actually mentioning, but I think the PM was perhaps a little bit more insistent that they at least stay for the time being.
Yeah, look, the Brits like to see themselves as a little bit different to the rest of the continent, I suppose, so continental Europe, and I mean they have maintained the pound, even though they are part of the EU.
Yep.
They maintain the pound, but I think that talk is probably more of a bit of beating of the chests and patriotism and maybe a bit of a threat. I mean, you've heard similar talk, from occasionally from certain politicians in the UK, in Germany, whichever country thinks that they're getting the raw end of the deal and sick of propping up countries like Greece and Spain. They like to threaten that, but I think it's more talk than anything.
Have you got any reading on what they might do with their bank rate over there?
Yeah, look, it's probably going to stay on hold, but they are looking, broadly speaking, they're looking to raise that, sometime soon. So
the UK is a big centre for financial institutions as well, isn't it?
Yes, it is.
It must make up a fair amount of their economy and GDP.
Yes, yeah, definitely, and I mean the British bank rate is. Close to the second most important after the Federal Reserve So it is an important one, but yeah, don't expect any major changes there.
Okay. Right, so as you can see, some important data coming out this next week, particularly keeping an eye on Greece there. News coming out in the USA, we'll get a bit of a feel for what's happening in terms of their employment rate, and obviously our RBA rate. It'd certainly be nice if it went down for all those of us who have mortgages, etc. But as Jeff mentioned, probably unlikely to happen for the time being. That's it for this week. Just a reminder, Monday morning 9 a.m. we have our weekly analysis session, so invites will go out for that very shortly, so keep an eye out for that. But other than that, thanks for sitting with me, Jeff, and we'll catch up with you all on Monday morning.
Thanks,
have a good
Dave.
weekend.
Thank you, everyone.